Welcome back to Smart Market Watch, your go-to source for stock market updates and insights. Today, we're tackling a big question that's been circulating in the financial world. Is the stock market headed for a crash? With rising inflation, slower earnings growth, and concerns over a potential recession, many investors are bracing for a downturn. But is a crash inevitable, or could the market avoid disaster? Before we dive in, don't forget to like this video and subscribe to Smart Market Watch for more stock analysis and market news. And remember, this video is for informational purposes only and is not financial advice. Be sure to do your own research or consult a financial advisor before making any investment decisions. First, let's talk about inflation. Inflation has been one of the most significant economic forces over the past couple of years. In 2021, US inflation was at 7%. Then it surged to a peak of 9.1% in June of 2022, the highest level since 1981. As of September 2024, inflation has cooled down to around 3.8%, but it's still above the Federal Reserve's target of 2%. Elevated inflation erodes purchasing power, making consumers and businesses tighten their belts, which can ultimately slow down economic growth. The Federal Reserve has responded by aggressively raising interest rates. From near-zero rates in early 2022, the Fed has increased rates to 5.5% as of September 2024. Higher interest rates make borrowing more expensive for businesses and consumers, which can lead to reduced corporate earnings and consumer spending. Historically, such rate hikes have been linked to economic slowdowns, with some analysts predicting the possibility of a recession. Let's shift to corporate earnings, which are showing signs of strain. In the second quarter of 2024, S&P 500 earnings grew by just 2.5% year-over-year, down from 6% in the same quarter last year. Tech giants like Apple and Amazon reported lower than expected earnings growth. For example, Apple posted 3% revenue growth for Q2 2024, compared to 9% in Q2 2023. According to Morgan Stanley, companies in sectors like tech and consumer goods are particularly vulnerable to slower earnings growth due to increased operating costs and reduced consumer spending. This has led some analysts to warn of a potential earnings recession, where corporate profits fall for consecutive quarters. So, what are economists saying? According to a survey by Bloomberg, the probability of a US recession in the next 12 months is around 60% as of September 2024. While not a guarantee, this is a significant increase from earlier in the year, when the probability was closer to 35%. Some economists believe the US could experience a soft landing, where inflation is brought under control without triggering a full-blown recession. However, others warn of a hard landing, where aggressive rate hikes could tip the economy into recession. Let's break down the possible scenarios. Soft landing. This is the best-case scenario where the economy slows down. Inflation is tamed, but we avoid a deep recession. In this case, the stock market might see a correction but not a major crash. Hard landing. If the Fed continues to raise rates aggressively, we could see a sharp economic slowdown, leading to a significant stock market decline. This would resemble the downturns seen during the dot-com bubble or the 2008 financial crisis. Full-blown recession. In the worst-case scenario, a full-scale recession could trigger a bear market, where stocks decline 20% or more. This would likely be accompanied by rising unemployment and widespread corporate losses. Expert opinions and historical comparisons. Now, what are the experts saying? Michael Burry, famous for predicting the 2008 housing crash, recently warned that we could be in a bubble similar to the one leading up to the 2008 financial crisis. In his view, inflated asset prices and aggressive Fed policy could lead to a significant downturn. On the other hand, Jeremy Siegel, professor at the Wharton School, believes that while the market could see a correction, a major crash is unlikely. He points out that corporate balance sheets are in better shape today than they were during previous market crises. Historically, markets have recovered from even the worst downturns. For example, during the dot-com bubble in the early 2000s, the Nasdaq lost almost 80% of its value, but by 2006 it had rebounded significantly. Similarly, the 2008 financial crisis wiped out trillions in market value, but the S&P 500 fully recovered by 2013. So what should investors do in the face of this uncertainty? First, it's important to stay calm. Historically, panic selling during market downturns locks in losses and can prevent you from benefiting from the eventual recovery. Warren Buffett famously said, "Be fearful when others are greedy, and be greedy when others are fearful," which suggests that times of market volatility can also present opportunities. Consider rebalancing your portfolio to ensure it aligns with your risk tolerance. Adding more defensive assets like bonds or dividend-paying stocks can help cushion against market volatility. And if you're a long-term investor, dollar-cost averaging is a great way to build your portfolio without worrying about short-term market fluctuations. In conclusion, while there are warning signs that the market could see a downturn, it's far from certain that a crash is imminent. Inflation, rising interest rates, and corporate earnings are all important factors to watch, but the market has proven resilient in the past. By staying informed, remaining calm, and sticking to a long-term investment strategy, you can navigate whatever the market throws your way. If you found this analysis helpful, don't forget to like this video and subscribe to Smart Market Watch for more market updates and insights. Leave a comment below. Do you think we're headed for a crash, or will the market weather the storm?